But the people that are in power, both in Canada and the United States, they went rogue. They embarked on a spending spree that we have never seen before in peacetime. We've got debt to GDP at World War II levels. The president of the World Economic Forum says Western debt levels in the government are at levels we have not seen since the Napoleonic War. We have gone through an extreme left experiment where the folks in power think that deficits don't matter. President Trump is to blame as much as President Biden. We're going to have a generational financial crisis. Larry Summers says the same thing. The yield curve is inverted. Do you know the only other time the yield curve has been inverted this long? How about 1929? Everything's there in history if you sit back and stop looking at your phone or your TikTok videos and basically sit there and do the basic work. Hope if Mr. Trump gets in, he puts in some moderate adults in the room. Right. I don't want any extreme right-wing economists that want to go back on the gold standard. I think we finally get a shot of what the post-COVID world looks like. I don't think we're through I think we're still through the echo phase. We're still dealing with the crap of COVID. AI is going to be the largest theme in our generation. I think we're in 1985. I think NVIDIA is Intel in 1985. We have yet to see a true AI company. I think Tesla will be the true AI company.
Mr. Jim Thorne has joined us today on the show. Jim, thank you so much for coming on.
Thanks for having me.
Before we get started, though, I'd like to ask you guys to subscribe to the channel if you haven't already. 87% of you guys who watch the content on this channel are still not subscribed. Let's go ahead and flip that ratio around. Go ahead and smash that subscribe button. I know, very cliche to say, but go ahead and hit that subscribe button, like the video. And Jim, this is your maiden voyage on the show. So I've got to ask you, who are you? What does your investment journey into this space look like? Kind of give us a rundown on who Jim Thorne is.
So my dad grew up in New York. I grew up in Toronto, Ontario. Youngest of 4 kids, got a PhD, learned the business in Toronto, got hired, went to the United States, joined a Warren Buffett-owned bank, grew that bank from number 70 to about number 9 when I left, went through 7 mergers. That's where I cut my teeth. My non-provocative views basically allowed me to survive the mergers. Decided to come back to Canada and help start up a company called Wellington Altus and sort of bring the American type views of investing back to Canada, which is basically controlled by banks. And so I get to have a platform where I can call balls and strikes the way I see them in an objective fashion, which if I work for a bank, it's very difficult to do. So that's kind of my journey. So I've been a CIO, I've been chief strategist, I've been chief economist. I attack my problems as a economist first. Basically, it's, the determining factor in building a portfolio is where do I think interest rates are going to go. So I'm a classically trained economist. I'm of this same class as Tiff Macklin, who's the governor of the Bank of Canada up here, or Mark Carney. We basically got our PhDs about the same time. So although I recognize that the central bankers are what we'll call the in crowd, the IMF and the World Bank subscribe to a particular version of economics, which is New Keynesian, right? I get the freedom of being on the outside of basically questioning that and saying, maybe it's not the be all and the end all that, the IMF, World Bank, and central banks say it to be. So I can be very provocative, but I am theoretically based, I am statistically and fact based, and I really don't have a problem in mixing it up in terms of standing for what I believe is right theoretically.
Is it true to say that most economists and policymaking positions tend to be labor economists? Like Janet Yellen, she's a labor economist.
Yeah, Janet went to Yale, and so she's a disciple of James Tobin. So what you find is, so it's weird because I got my PhD from York University. I'm a mutt, right? So I was lucky enough to get my macroeconomics taught to me by about some very smart guys from University of Chicago. I got my microeconomics taught to me from a bunch of really smart guys from the London School of Economics, which is basically it was George Akerlof, which is actually Janet Yellen's husband, right? And a bunch of game theorists coming out of the Russian game theorists coming out of the University of Haifa. Add on that York was the hotbed of political science in Canada, so you had a lot of extreme. This is before universities were much more objective, and so I've read Adam Smith's both texts. Like the first one that everybody talks about is The Wealth of Nations, but no one really talks about the theory of moral sediments, and no one really talks about Carl Polanyi's Great Transformation. So I'm a jack of all trades, masters of none. But yes, once you understand that the economists that are what I call on the inside come from a particular narrow sect of fundamental economics, which is new Keynesian economics, which means the Phillips curve works, right? Which means that I'm going to bore you that, you only have to look at the demand side, that there's a thing called the virtuous cycle. When you hear the folks that are trained, and we could go down this whole rabbit hole of, there are folks on the Fed that have votes, that have an undergraduate degree in advertising and a law degree. Okay. Think about if that person was on the Supreme Court. Okay. And so you have a lot of folks on the FOMC, on the Fed, that are over their skis because they're not subject matter experts. Hey, listen, I respect power. I don't want to name these people, right? But if you don't have an undergraduate degree, like for example, the new president of the Cleveland Fed is a very capable individual coming out of Goldman Sachs. Very smart. She controlled all the trading platforms. When she worked through Goldman, she controlled the trading platform. She's a trader. Okay? She's a mile wide and an inch deep. I don't know. I've been in this business over 25 years. That's not to say that she's not smart, not experienced, not well thought out, right? But she has no clue about, Adam Smith's theory on moral sentiments, or Irving Fisher's, or, Keynes' theory on just, or Milton Friedman and Anna Schwartz. And it's so important during this time, which is so nuanced, that we have people making important decisions, and they don't understand that you get to a period of time in the cycle where interest rate hikes are inflationary. That is the case right now. And if you wanted to get interest rates down, inflation down, all you have to do is cut rates. Up here in Canada, 30% of CPI is mortgage interest costs. That's Bank of Canada rate hikes. That's not me developing cold fusion. That's advanced macroeconomics, right? And if you have an undergraduate degree in advertising, or you have an MBA with 1 degree in macroeconomics, and you're out telling me about, higher for longer, really? And that's how dangerous this is, right? They don't know what they don't know. They're over their skis. And let me be clear, they've already made a policy mistake. The cement has been poured. It's over. It's not about 25 basis points. The yield curve is inverted. We have to normalize rates, right? 25 and 26 are going to be nasty. And they're going to sit there and go, we didn't know. When you have the head of the Federal Reserve saying they are confused about inflation, when anybody who's been following the data set knows that the first 3 months of the year are always the hottest three prints, because inflation is really driven by gasoline prices and oil prices. And gasoline and oil prices always ramp up from December to April for the driving season in the United States. And they're confused. Okay, are we in trouble or what?
Yeah. I mean, that's quite the picture you've painted there, Jim. Jerome Powell as well. They call him private equity Powell. You know, he's not trained in economics or the philosophical or scientific underpinnings of the concepts that you've kind of explained there as well. What do you think of Powell?
Smart guy. I mean, so I lived in DC for 15 years, right? I'm moving around, right? So it's funny living in DC and having a different picture. So I have he's a very smart man. He's a very successful man. He's doing as good a job. He's trying to herd cats, right? He's doing listen, I got to be honest with you. Look, this does not, as far as I am concerned, this does not fall down on Powell. Is not to blame. And the reason why I say this is, look, I'll put it generally, but the people that are in power, both in Canada and the United States, they went rogue. And after we basically did some fiscal policy spending and monetary policy to deal with COVID, they basically, we should have stopped in about 21. Okay. They embarked on a spending spree that we have never seen before in peacetime, right? We got a deficit of 7%. We've got debt to GDP at World War II levels. The president of the World Economic Forum says Western debt levels in the government are at levels we have not seen since the Napoleonic Wars. And so we have gone through an extreme left experiment where the folks in power think that deficits don't matter, right? Modern monetary theory, right? Well, excuse me, interest payments on the debt in the United States is dwarfing military spending. Let's add on Medicare and Medicaid and Social Securities. And this is the biggest issue that we're not talking about. And so the crisis, I would say to you, Danny, is not that right now coming into the election, it's 25 and 26. The debt is unsustainable. Okay? Let me be fair as a researcher. President Trump is to blame as much as President Biden. Okay? President Trump's 2017 policy that was tried to be implemented by Liz Truss in the United Kingdom got viscerally rejected by the capital markets. We have, as we're taping it today, we have a debate tonight where Trump and Biden aren't touching the elephant in the room. We either deal with this deficit or we have a 1987 crash on our hands in the next couple of years. Because what is going to transpire is that there is no adult in the room. This is not about Jerome Powell. This is about the president of the United States continually using executive orders to increase spending. Right?
Right. How do you deal with the debt crisis?
Well, you've got to have, so let me just say to you in this way, right? And this is my personal opinion. I'm trying to, so let me, it's weird. Okay, Dan. So you're taping me and I'm in Toronto, right? I grew up in Toronto. My dad's American. when I lived in DC, if I got on a plane and flew to DC and we met in my neighborhood and had a party, right? A barbecue, I would be viewed as a staunch Democrat. Okay.
Right.
Up here, I'm a Republican or I'm a conservative, right? And the reason why I want to say it is I am a man without a country. I am a man without a political party, right? I'm trying to be objective. And here's what I want to say explicitly and bluntly. The period of time of extreme economic policy has to stop. On the left, modern monetary theorem is bunk. Deficits matter. Okay. And on the right, extreme right fiscal policy, trickle down economics does not work. Okay. We need to finally wake up and meet in the middle with a thoughtful program that focuses on economic growth in the private sector, yet at the same point in time, tackle the required and needed areas that we need to focus on in the public sector to ensure productivity growth and enhancing growth in the private sector. And as of yet, unfortunately, neither of these presidential candidates have touched this with a 10-foot pole. This is not about building the wall, right? This isn't about canceling student loan debt.
Yeah.
Right? That's the risk. And the point is, if we look at the United States as an empire, like the Roman Empire, right? I hear too many folks on Wall Street, and this is what they say. It's like the parable of Noah's Ark in the Bible. I've been hearing about this debt, the risk of debt, and we defaulting on debt for all my career. This is Peter and the Wolf. This is blah, this isn't going to happen, yada, 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 until it doesn't, right? And then they sit there, the economy's wiped out, and then they go, who knew, right? Well, the signposts are on the right now are speaking towards a total lack of confidence in policymakers to deal with this in periods of time throughout history. If we do not get individuals in the White House that are going to thoughtfully attack this, then the credit markets will force it down our throats. It will not be pretty.
What's the most likely scenario? So you've laid out what should be done, but what's most likely going to happen in your eyes?
Well, the simple. So if we use World War II, post World War II as a roadmap, is what I've been trying to do, is we need to have a pro-growth strategy, right? That's private sector. So the GDP number that came out today was all driven by the government spending.
Yep.
All right. Okay. That's bunk. That's not real growth. That's a mirage. So we need growth, and we need to stop increasing government spending. And we need to take what we are spending on and be focused on what we are spending our money on. Okay. So we need to stop the growth. What do we do with Trump's tax cuts? Do we let them run off? But we've got to stop just spending money, as Senator Kennedy from Louisiana says, like pond water. Okay? That's his terms, not my term. And everybody knows this. The only people that aren't talking about this are the people in Washington, D.C. and Wall Street that live in an echo chamber. Right? And so why do I use 1987 as the reference point? Because we lost control of the U.S. dollar in the 80s, right? We had the Plaza Accord. We had the Louvre Accord. The yield curve was inverted, right? Greenspan increased, and we had a narrow stock market, just like we have right now. Eventually, what's going to happen is the credit market is going to say no mas.
Yeah, but aren't these politicians essentially just slaves to these voting blocks that want nothing to do with reining in spending?
Uh,
When
yeah, but this is so what you're doing now, Dan, is you're going to there is no solution. I've heard this forever. And all I'll say is John Maynard Keynes warned Harry Dexter White in 1945 at Bretton Woods that said, you are going to do exactly what the Romans did.
Mm.
And the Americans, look it, okay, my dad, you're doing it. Wake up. This is real. You guys blow this, you own it. This is real. If you think Chuck Schumer knows what the heck is going on, come on. Right?
Yeah.
But the point is, it is to the point where it is significant. Right? You've got demographics. You guys spent money like it was no tomorrow. You have a 7% deficit and unemployment is 4%. Hello?
Yeah.
Want me to keep going with the facts?
Mm-hmm.
Right? And why do you think Powell is keeping rates high? And why does he not have confidence? It's not that he doesn't have confidence in the data. He is objectively focusing on the most lagging part of the price data set, which is owner's equivalent rent and core services. Now, everybody say, why? I have no idea, but I'll give you a reason. He doesn't trust President Biden. He doesn't trust Janet Yellen. He doesn't trust Leo Brainard. He doesn't trust any of these folks because they're spending money like pond water, right? And Thomas Sargent won the Nobel Prize in economics on this simple point. Permanent inflation is everywhere and always a fiscal phenomenon.
And they've
always... So here's my point to you. If they don't stop, we're going to have a generational financial crisis. Larry Summers says the same thing. Right now, you go turn on the business stations and listen to the guys and from the money center. The same guys, frankly, remember these are the same institutions in 2007 said there's no subprime crisis. Right? You guys are listening to those guys. Good luck. Right? Right? These are the same guys that said when they attacked Hong Kong's peg in 1997. That there was no problem, right? 12 months later, 5 or 6 of the largest prime brokers almost took Wall Street under because Russia defaulted on the debt.
Yeah. What's this tendency about listening to people who are always wrong?
Beg your pardon?
I said there's this tendency about always listening to people who are always wrong just because they're in high positions of power.
No, I think my suggestion to you is the narrative that I'm painting is not unique. They just don't go on TV.
Right.
They just don't go on media. Right? You get bureaucrats that work for a large bank going on and they basically have talking point mail. I couldn't say this if I worked for a bank. You kidding me? Right? We're worried about 25 basis points. Dude, it's not about 25 basis points. The yield curve is inverted. Do you know the only other time the yield curve has been inverted this long? How about 1929?
Oh, wow.
Dude, here, put a loaded gun in your hand. You guys have no clue how dangerous this is. Now, am I saying it's going to happen? No, but think about this. You have a big pile of wood and you poured a ton of gasoline on it. Right? We got a block party. We're back to university. We're going to have a party. And some dude's going to walk up there and throw a match on it. What do you think's going to happen when it lights? We have no idea where it's going to blow up. They all invest the same way. Right? Think about this. They took rates from 0 to 5%.
Mm-hmm.
Right? Everybody has bonds, government bonds on their balance sheet that are underwater that if they mark to market, they would not meet their tier 1 capital ratios. Everybody's in the same boat. And yet we're talking about 25 basis points? Really? Come on, guys. The emperor has no clothes. How quickly can we uninvert the yield curve? How quickly can we get short rates below long rates? How quickly can Powell get cut 150 basis points at least? And Dan, once they do that, it's going to take at least 18 months for that to go through the system.
The lag
in
effect.
fact, it's most likely going to take longer in the United States because you guys are less interest rate sensitive. Up here in Canada, because we are more interest rate sensitive, it's going to take 18 months. It might take 2 years. So let's think about Powell. We're talking 25 in July. Dude, what do you think it's going to look like in 26? And then what do you think the bureaucrats going on to CNBC are going to say? Whoa, you know, come on. Investing is about the future, right? And if we're playing poker, you got to determine whether or not you're the sucker at the pool at the poker table or not. If you don't know who the sucker is, if you don't know who the dumb money is, then you're the dumb money.
Yep.
Okay. And the market is trading exactly. Let me give you an example. Yield curve is inverted. What do? You buy secular growth. What's working? AI. Dan, do you know that going back and looking at decades worth of data, that basically 2.39% of stocks create all the wealth created? Let's round that up to 3%. Okay. And let's focus on the S&P 500. That's 15 stocks, Dan. Yeah, look at Warren Buffett's portfolio. Look how concentrated his portfolio is. And we got guys sitting there going, value's going to outperform. How? The yield curve is telling you that the Fed is going to willing to pound the private sector into submission because of what's happening in the White House. And you want to buy a value stock? Based on what? Based on what? So everything here is logical. It's based on history. I gave you a plausible narrative why I think Mr. Powell is doing what he's doing. He's a very smart man. I would not want to be in his position, right? You know, when you have a Fed governor or a Fed president out a week ago saying they might raise rates. I mean, what? What was her PhD thesis in? Right? And everybody's just hanging around. Right? Everybody's just, oh, that's cool. Right? So very dangerous times. And the only reason why it's really dangerous, it's the amount of debt. We don't know where this is going to break loose. But if it breaks loose, there is no getting the genie back in the bottle. None.
Yeah, this is unprecedented. I mean, you mentioned the debt to GDP ratio at 130%. Typically throughout historically, once you get around 100% or so, that's when you have your sovereign debt crisis. So it's, I mean, we are, you know, many levels above where the historical precedence is.
And you got, you know, the Reinhardts, Cameron and Vincent and John Rogoff wrote a very important paper coming out of the global financial crisis talking about what happens when debt to GDP gets over 100%, right? Growth slows and we get deflation. We have deflationary pressures all over the place. Demographics, debt to GDP, digitization, right? Globalization. They're all stronger than they were beforehand. And so if we go back to the 1940s, what happens is we get a growth scare and we go back to deflation, which is exactly what we were in 2000, like between 2008 and 2020, right? You know, in 1920, we had the Forgotten Depression, right? What came out of the 1920s? You had a wartime economy and you had an economy that was supported because of the Spanish flu, right? What happens when we came out of that? We had a depression, right? That's when Benjamin Strong, who was the president of the New York Fed, had to come up with open market operations for the Fed, right? And started pumping money. And we got the roaring 20s, right? Everything's there in history if you sit back and stop looking at your phone or your TikTok videos and basically sit there and do the basic work. And Milton Friedman's 90th birthday, Ben Bernanke gave the keynote speech, and at the end of it, he said, "You and Anna Schwartz were right. We caused the depression. The central banks.
Mm-hmm.
They inverted the yield curve in 1929."
Yep. It's a funny thing because in the forgotten depression that you alluded to, was there really no, I guess, interference from the central banks back then? Is that why we did have a depression, but it wasn't as prolonged as the Great Depression, which had the fingerprints of the central banks on it? Hey guys, quick pause. Looking for the best gold and silver prices out there? Well, I have scoured all throughout the internet trying to find you guys the best prices, and I think Miles Franklin does it for me. In my opinion, I haven't really been able to find anything else that compares to their prices. You really don't want to. What you really want to do, however, is you want to email them at info@milesfranklin.com, and you want to say that Capital Cosm sent me in the subject line, because if you do that, you'll get their special pricing guide. That's some of the most competitive pricing out there. No commitment necessary. Info@milesfranklin.com, and Capital Cosm sent me in the subject line. And now let's get back to the video.
Because Benjamin Strong basically increased the money supply through open market operations unfettered. So he didn't have, at that point in time, the New York Fed controlled the purse strings. It's not this, herding of cats now where you've got all these governors from around. He did it. He saved it. And when he died in 28, they reversed the policies. And that's what caused the Great Depression. And that's Ben Bernanke talking, and that's Milton Friedman talking, and that's Anna Schwartz talking. That's fact. That's history. And if anybody on Wall Street wants to argue against that, then show me the work.
So what's kind of the order of operations that you see unfolding? Is it inflation first and then deflation, or the other way around?
The inflation that we were experiencing coming into COVID was the supply side shock. We had twin supply side shocks, right? We had the closing and opening of the economy, right? We had the Fed, Jay Powell saved the day. And I honestly mean he did. He invoked Section 13.3 of the Federal Reserve, which hadn't been basically activated since World War II. And what he basically did was he wrote a blank check for he wrote a check for $5 trillion and gave it to Janet Yellen, or gave it to the Treasury. And then he did quantitative easing. And then what we did is we closed the global economy down. So we gave you a ton of money to sit at home and not do any work. Okay. But yet we shut down the supply line. So there was no food for you to buy or cars to buy. So we created the inflation through the supply shock. And then the second shock was the Ukraine war. Right. And so economic theory, and Alan Blinder, who did a wonderful work in the late 80s, saying that if Volcker just would have done nothing, the inflation from the supply shocks of the 1970s would have dissipated and inflation would have gone down. Okay? So that was the first step. The second step was, what happened is as the economy was slowly opening in 2021, Speaker Pelosi and Joe Biden took the leftover money that shouldn't have been spent and implemented, modern monetary theory, and we got extreme progressive left economic policies, rightly or wrongly. Okay, I'm not so in a democratic society, and it happened up here in Canada as well. Right? Trudeau and Friedland did the same thing. I don't think anybody voted for it. I don't think, at least up here, what's happened up here with Trudeau's Liberals is everybody's really upset. He lost the most red seat in the country this week, right?
Yep.
Has been Liberal for 30 years. Why? Because, and it's the same thing I would say with Mr. Biden, is I don't think people put Mr. Biden in for extreme progressive policies. I don't think people put the Liberals in. I think typically, whether you're left or right of center, the majority of the electorate's moderate. Right?
Yep.
And so, but Biden and Trudeau went on this spending spree that we've never seen before in economic history. And that too was inflationary. Right? And it's unfortunate because both of the central bankers up here and in the United States, they got hung out to dry by the policymakers. And if, as and when we go through another financial crisis, I don't think the Bank of Canada and the Fed will ever do what they did again. And nor should they, because you can't trust the policymakers, can you? Whether on both sides, right? You give them money, they'll spend it. Whether it's inflationary or not, they will spend it, right?
So what should be on the radar screen of the average retail investor out there, or the average person, let's say?
So for me, it's, I don't think it's the election. I think whether or not, I don't know who's going to win, right? So let's just say it's, but really to me, what I am looking at is next year.
Mm-hmm.
And what I'm looking at is, let's assume Mr. Trump gets in. Is he going to fill his cabinet with extreme right-wing policymakers? Is he going to go through, are we going to have to go through Trump 1, where he goes through and tries to implement extreme right-wing policies? If we do, we're in trouble. If Mr. Biden wins and he brings out the same cast of characters that says deficits don't matter, we're going to keep spending money like pond water, then we're in trouble. And if those are the cases or the signposts along the way, then I would expect a visceral response by the credit markets. And I think between now and the end of 26, we will have a event that will force these policymakers to become rational. And that's kind of my base case. So I'm trying to think about what this looks like early next year, if you get my drift. And right. You know, to me, I hope if Mr. Trump gets in, he puts in some moderate adults in the room. Right. I don't want any extreme right-wing economists that want to go back on the gold standard. You know what I mean? That type of stuff. Yeah. It's over. Like this extreme right-wing, left-wing stuff's got to stop. The peripheries have had enough. Can we get the
red team versus blue team stuff has to come to an end?
Yeah. And so that's, and the same thing. And so the same thing with President Biden. And I think we're, you know, the next step along the way is this, and I really want to focus on that, is because people say, well, we need gridlock. Well, we had gridlock. We have gridlock now. Mm-hmm. But President Biden, these guys are using this executive order stuff to do whatever the heck they want to do, whether it's constitutional or not, and basically let the U.S. Supreme Court be the you know, the umpire, which is wrong. But that precedent was set years ago. Right? When President Obama implemented the net worth sweep on Freddie and Fannie to finance Obamacare. Right? I'm not saying it's right or wrong. Right? And let me be clear here. Like when I lived in DC, I think there should be public health care. Right? That's where everybody would say I'm Democrat. I think we need strong public health care and we need strong public education. Right? But we got to do it the right way. Right. And President Obama, you lost a fight to be able to tax for Obamacare. And he went and he basically took the net worth sweep, which was basically he swept the net worth of Freddie and Fannie, which are the mortgage insurers, swept it into the Treasury. And that was basically to finance the discounts and the subsidies for Obamacare. So let me be clear. I am not saying that there shouldn't be Obamacare and there shouldn't be public health care. I'm saying there is. That was the precedent that was set forth. And hedge funds bought Freddie and Fannie and took this to court, right? And they could not get what should be common sense, a ruling on it, right? The government can't come in and basically, you know, abscond the net worth, free cash flows of a publicly traded institution. Even though it's pseudo-private and all the history of about, you know, Freddie and Fannie. But ever since then, on both sides of the ball, the administrations have used the executive order to get around. the checks and balances that should be there in the House and the Senate. That's where law is made, right? We got to get back. We got to get back to the checks and balances of what the founding fathers said, right? And I don't want to be hyperbolic here, but it's just common sense stuff, right? I mean, President Biden wants to get rid of student loans. That's a noble thing, right? But you shouldn't do it through an executive order that's deemed unconstitutional, right? You should put it in a bill, right? Get Congress and the Senate to vote on it, right? Let's go through how this system was supposed to work. But for whatever reason, I'm going off on a tangent here. We govern, the president governs his policies through the executive orders, and it's got to stop.
Yeah, and that's been a pretty clear trend now for at least 20 years, from what I've noticed. You mentioned the gold standard early on. We have got a lot of gold bugs who watch this show. So can you explain why the gold standard may not work or won't work from your standpoint?
Well, let me just be clear. I think gold's a core position in anybody's portfolio. So let me just be clear. I think a traditional portfolio should have 3 to 5%. And if you're a younger generation and you don't like gold, buy Bitcoin, right? An alternative store of value is important. Okay. I just think we have gone down the path that I just don't think that in theory it would work. I just think that it would be, the adjustment process would be too painful.
I see.
I would put it that way. And I just think that even though theoretically I accept it, I just think if you put those economists on the Fed or in the cabinet, it would just be a circus show in Washington, D.C. Right? So back in Bretton Woods, Keynes warned the Americans and said, you are going down the path of every other empire that has existed throughout time. Eventually, everybody will devalue their currency against yours. You will go from a creditor nation to a debtor nation. Your standard of living will fall. Okay? And you no longer will become an economic power based on manufacturing. Right? Keynes called it. Harry Dexter White basically said to appease Keynes, he put everybody on the gold standard, which worked until Nixon closed the gold standard in the 1970s, right? So I would just suggest to you that the power is just like me saying to you, I really hope that if Mr. Trump gets in for a second term, that he understands the fact that the swamp can't be drained. And don't waste your time. There's too much work that needs to be done. It is what it is. And I just don't think that it works. Now, could there be, Keynes said there should be a global currency called Bancor, right? And so, what am I saying? I say, yeah, I get it. But you know what? The time to have done that and maintained that is typically after a significant global crisis like World War, right? And we had that shot and we didn't do anything about it. So it's the same thing. I don't think Bitcoin's going to replace the US dollar. I think the US dollar is going to be the medium of exchange of the global economy, right?
Okay.
I do think, though, that given the actions of the United States towards Russia and the treasuries that they owned, and coming up with a situation that they're going to use the income generated from those treasury bonds to finance the reconstruction of Ukraine, either right or wrong, right? I understand what they're doing, right? I don't have a horror, I understand the gravity. I don't want to get involved, right? I understand Ukraine. I support Ukraine. So let me just, I just want to put that out there. But as you look at it, I mean, how does that not tarnish the reputation of the U.S. Treasury, of U.S. Treasuries being the gold standard in the store of value game? I mean, people, and that's why gold's got a bid, right? Maybe you don't want to have all your assets in U.S. Treasuries, right? Maybe one day you're worried, you want to diversify, right? Maybe one day something happens with you in the United States, and all of a sudden, it would be a reasonable conversation to have around the table in some places of the world, no?
Yeah,
You would think, right?
Yeah, my observation has been with BRICS, for example, they came on the scene in the mid 2010s. They made a big splash and then they just went radio silent for a number of years. Now, all of a sudden, post Ukraine Russia war, you're starting to see the reemergence of BRICS and with greater and greater prominence. More countries want to be a part of BRICS. And you can't help but wonder, it's probably because what you've alluded to here, the fact that you've destroyed the rule of law or the perception of the rule of law here in the United States. You have all these other countries that are looking to each other and saying, hey, that could also be us. So why don't we get together? Let's call it BRICS. And let's figure out a settlement currency amongst ourselves. It could be backed by gold or a basket of commodities, whatever. Is that your kind of prognosis of BRICS and this so-called de-dollarization story that's been picked up for the last number of years?
But in a free global market, if I was trading something internationally, I want to get paid in US dollars. Mm-hmm. Okay. Hey, if you want to sell your stuff and get Russian rubles and you want to have to deal with somebody else taking your Russian rubles from you because you want to purchase something else, God bless you. This is it's the pursuit of happiness, right? God bless you. I think they're insane. If Saudi Arabia wants to take Russian rubles or India wants to trade with Russia in rubles and rupees amongst themselves, and they want to go back and forth, great. Okay. But it doesn't, to me, deter the fact that the most important medium of exchange in the global economy is King Dollar, and it will be for my lifetime. But, if you want to think about sort of the nuance of what we need to see happen to finance the U.S. debt, we need a depreciation of the U.S. dollar. And I think it's overvalued right now. And we need interest rates to come down, along with reasonable revenue enhancing ideas in the United States and spending cuts in the United States. So, the Japanese yen is through 160, right? But if you look at the spread between the 10-year US and the 10-year Japanese bonds, fair value is about 140, right? Currencies, there's a lot of FOMO that needs to be unwound, right? And so, so fair value on the yen is 140. I think, going back to what we talked about earlier, I know the Fed wants to get the interest rates, the Fed funds rate about 2.5%, right? I think they've blown it. There is a model in the New York Fed that estimates what R star is, right? Which is the natural rate of interest. It's about 75 basis points. So I honestly think that when you're trying to land a 747 on a postage stamp, that they're going to overshoot. Right? Rates are going to have to come down. Growth is going to come down. I think the dollar is going to come down. I'm not saying it's going to go crazy. I just think it's going to go back to a normal level. And I think gold's going to be great. I think Bitcoin's going to do fine. I think secular growth is going to be good, the place to be. And the real question we have to ask ourselves is, after this adjustment process, like let's say 26, 27, when let's say we go down, we overshoot, everybody freaks out, everybody realizes it's okay, then Fed funds rates say at 2%, which would be exactly the same cadence of coming out of the late 40s into 50, right? We go down, we overshoot, we pop back up. What does it look like? What does growth look like? You know what I mean? What is this really? And then at that point in time, Danny, I think we finally get a shot of what the post-COVID world looks like. I don't think we're through I think we're still through the echo phase. We're still dealing with the crap of COVID.
That's a good point.
Right?
Yeah.
And so that's what I try to do, what I'm allowed to do is, I am, with you and I are talking, we're building portfolios. I am forcing you to think 14 to 16 to 18 months out. Stop thinking about the 25 basis point cuts. That's not important. It's what happens when whoever gets in power. What do they do? I feel like if we're up here in Canada, I used to do canoe tripping. So as a strategist or an economist, I'm a tripper. Right, we're shooting a rapids. We're shooting this river that never ends, right? And so we're getting through. It's not this set of rapids, dudes. We got 2 days of good good paddling, and then we hit these sets of rapids. Is the water high enough? Do we need to portage around it? Well, we'll make a decision when we get there. But if we start talking about it now, you might say to me, Jim, you're crazy. Yeah, great. But you're thinking about it now. Right. And as portfolio managers or anything in strategy, you listen to Tom Brady talk in football. I saw him talk to Steve Young, and they say the reason why they did so much work, right, looking at tapes and looking at everything, is that when something happened, they had done so much work that they knew exactly what to do and the decision to make at that point in time. As opposed to saying, they do Tampa 2, and what am I supposed to do? And da-da-da-da-da. They've done so much work in prepping for when that event happens. You've got your strategy in place, right? You're thinking about the signposts along the way. Like I just gave it to you. If Trump comes in there and he puts in an extreme right-wing nut job economist, right? If he builds a cabinet like he did Trump 1.0, we're in big trouble. If Trump tries to implement his 2017 policy, we're in big trouble. Look what they did to Liz Truss. She implemented his policy, and she got smoked in 45 days. Look what happened to the financial markets. She implemented Trump's policies. You don't have to believe me. Just look at that. If he thinks and I don't know who's advising, if he thinks he's going to do the 2017 thing
with the revolving door administration,
oh my gosh, we are in trouble, my friend. Right? And I don't have a horse, but this is my point. And the hard part in all of this is when we've gotten to the point where we used to talk about this all the time, objectively, right? I'm talking to you as a strategist and an economist. I'm trying to alleviate or take out the Trump and the Biden supporter. I'm trying to depoliticize the discussion and say, we're investing money. How do you want to invest, and what do you look for? Right? So I think we're in a global reflation cycle. Debt has to be refinanced. We can't live at 5%. Okay? The sooner we get there, the better. Okay? The longer it takes, the lower rates are going to go. All right? Wait till 20, and then at the lower. And so when you think about it, what is the conversation you and I are going to have in 26 at this time when interest rates are at 150 and everybody's freaking out? And I'll go, hey, Danny, remember the 24 conversation we had? And now everybody's freaking out?
That's how typically how it goes.
That's how it goes. right?
So over the course of the last 3 or so interviews, I've implemented a new kind of theme towards the end of the show where I basically ask the guest to leave me with a question to ask the following guest after you. So I'm going to pose it to you right now. If you could ask whoever my next guest is any question, what would it be?
What facts do you have that support the thesis that interest rates are going to stay higher for longer and we are in a new high inflationary environment? What
That's a good one.
facts? Not beliefs, not feelings, not bias. What facts?
Gotcha. And the question that I got from my previous guest before you, who I recorded an interview with just a couple hours ago, Chris Vermeulen. If you haven't seen that episode, guys, go ahead and check it out. So he was basically just asking.
I want to ask a Tesla question.
Okay.
So I recently saw Elon talking about how Tesla wants to get into doing these robots and how they think there's a billion, robot market a year. Everybody has their own personal robot. I guess my question would be, is Tesla a buy at this stage for insane growth if they haven't even really started the robot phase and they're about to like explode it up? To me, it's interesting. I like the idea that if Tesla's getting into that, and I don't follow it. I'm not, I'm not a brand person. Like I don't follow Tesla or Apple or any of that stuff, but it'd be interesting to see, is Tesla going to hold its ground, and is AI in the robot space going to send their stock, into orbit even more from where it is?
Well, okay, that's a great question. So I hate to use that term. Okay, so look, I think AI is going to be the largest theme in our generation. I think we're in 1985. I think NVIDIA is Intel in 1985. We have yet to see a true AI company. I think Tesla will be the true AI company.
Wow.
I think Tesla is positioned to implement all, when you think about it, taking electrons and converting it into an intelligence for value. If there's a company that's going to do that, it's going to be Tesla. So I internally today, because it's all about, rotating the capital in those 15 stocks. I've been suggesting internally that teams need to start looking at this again, because, eventually what's going to happen is NVIDIA is going to launch Blackwell. It's going to be the largest product launch ever. But eventually what's going to happen is, Tesla or Musk has contacted Dell and Supermicro to build the state-of-the-art server farm using Blackwell so that he can take all of that data and convert it into intelligence to generate value. Tesla's got all this data that it needs to basically build a supercomputer on to basically implement it. So I think Tesla is going to be the quintessential AI company. Think, not a chip company, not a semi-cap company, not a, Dell's there on it with a server company, or Supermicro or Apple making it, putting it in my phone. I think they have a shot at becoming the AI company. And think about it, Danny, we don't have one yet. Think about the evolutionary process that we have to go through. That's how early we are in this thing. So if anybody can do it, it is Elon Musk. And the reason why I say, if the dude can land a rocket on a drone in the ocean, the guy's impressive. That's all I'm going to say.
He's going there.
So I would not, but you know what? He's hated on Wall Street. Wall Street, you cannot underestimate the bias, the negative bias of, there are guys on Wall Street that still think Micron is only a NAND manufacturer, right? NAND is like the memory stuff from the 80s. Okay. Yep. There are guys going to sit there and go, you don't want to buy Tesla because it's a car company. Tesla is not a car company. It's a manufacturing company. It's a data company. It's an AI company. So it really depends on your time frame. But I think there's really smart people that understand the evolutionary process. And if you ask that question that way, right, ask the different question is who's going to shot at being an AI company, not a a picks and shovel company. That's NVIDIA, right? Dell is Dell's going to build the new server farm. We're gonna go through this phase of building all these server farms, right? We're gonna go from a CPU centric economy to a GPU. Okay, so we're gonna go through that building phase. But once we go through all of that, and you got all that data, and you convert that into intelligence, and then you convert the intelligence into value, who's going to do that? And I say Tesla's got a really good shot at being one of the many companies that does that.
Wow. So we went from pessimism to a sense of optimism towards the end. That was a...
Oh, no, secular bull market. Okay. Into the end of the decade. I want to be blunt on this, guys, but let me be clear. Everything that I said, let's not discount the fact that there are a lot of smart people in the Democratic Party. There's a lot of smart people in the Republican Party, and there's a lot of smart people, in Washington and at the Fed. Like, let's flush the narrative that these guys are as dumb as a box of rocks. They're really smart. They get this. We're going to be watching the making of the sausage. The United States is the place to be. Okay. It's the best place. So if you talk to me about investing, buy the United States, buy secular growth, right? Soft landing in the United States. Can't say that much in Canada or in Europe. Okay. I think cooler heads are going to prevail. I think I was a little bit hyperbolic in my presentation because if they don't do it, the ramifications are significant and severe. But I think they understand that, and we're going to get there. And I'm bullish on the United States, and I'm bullish on the markets.
Fantastic. Well, it's a pleasure having you on here, Jim. I also ask this to my guests frequently, and it's what's a book that you'd recommend the audience pick up? If you could pick one or two books out there, do you recommend they read?
Oh my gosh. There are two. Can I give you a twofer?
Go ahead.
It's George Gilder, right? He wrote After TV, and then he wrote After Google. And you got to read After TV because when Jobs came back and took over Apple for the second time, he got everybody to read it, and Gilder just nailed that theme from what Apple did. He just nailed the internet. And then after Google, everything we just talked about is there. So what I'm saying, they're really smart people. Really, you guys, that might be the first time you've read it. Yeah, I would read that. I think he's mind, that will open your mind. And then for demographics and everything, it would be Strauss and Howe and the Fourth Turning.
Oh, got that right there. I don't know if you can see it.
Right. It's perfect. We're exactly where the rise of populism throughout history marks major structural change. And what is so positive about the United States is the United States is willing to go through these very painful structural adjustment periods. Do you have kids?
Yes.
How old are they?
Just like an infant.
Okay, so I have two older daughters, right? But I can remember when they were growing, they would in the middle of the night, they'd come and say, my legs hurt because they were growing. You know what I mean? And the discussion with me and my wife is you give them Tylenol, or what do we do? But growing hurts. And one of the unique things that the Americans, that you guys do, I should say, because I'm part of the family. My dad, I shouldn't. It's weird saying that, but look, we're willing to air our dirty laundry. We are willing to go through tough structural adjustment periods to ensure that we are at the forefront of economic growth and innovation for the next generation. And what we are going through right now, although it is as painful as it seems, and it is as dangerous as it seems, and it is high stakes as it seems, no other country in the world can do it, dude. And we're gonna do it. You got it right now. Think about this in AI and crypto. Who are the leaders? Where?
Right here.
Europe?
Yeah.
Not in Canada. The technology company in Canada is Shopify. Right? We were there in the 90s. So I'm very bullish on the United States. But could we have a bump along the way? Sure. Is it over? No. And very, very bullish. And, I would say if you overlay the demographics, so there's a book up here called Boom Bust Echo, right? It's a demographic book, and all they did. So, okay, let me pull back. Modigliani won the Nobel Prize in economics for the life cycle theory, which basically says following where you are in your life, you save, you consume, you invest, typical stuff. He won the 85 Nobel Prize on it. You overlay demographics on that, and then you overlay that onto the stock market. What you find is that when you get big cohorts going through the stock market or in society, the stock market has a secular bull market. And when that cohort ceases to have influence, the stock market peaks. So that's why you read, the fourth turning, right? Because that's where we are. So when does the millennials stop having, you look like you're in a middle. When do you guys stop? When do you peak? Early next decade. And you invest differently than the boomers. And when did the boomers influence peak? About 2000. And how did the boomers invest? And boomers, it was active mutual funds, right? You guys, it's crypto and ETFs, right? And options, right? And then you get the silent generation. And if you overlay demographics, we got a massive run until the next decade. But could you have like a 1997 long-term capital management event, which is what I'm presenting to you? Could you have a significant bump along the way? Yeah, we had it in the 90s, right? We had it started in Hong Kong, went to Thailand, worked its way around the world. Russia defaulted on its debt. And oh, by the way, Wall Street woke up one morning and said this hedge fund that's controlled by a bunch of Nobel laureates, has 50-to-1 leverage, and we're all screwed. And that was the beginning of too big to fail.
Yep.
Right?
I remember that.
So never say never, but you're always looking for that probable tail risk that might happen. And that's why I say to you, gosh, there's a lot of checking the boxes that looks like this is 1987, right? You had the Louvre Accord, you had the Plaza Accord. Inflation was coming down. They were still spending money like drunken sailors. Yeah, the whole mishmash. You had a narrowing breadth of the market. Something happened, and then the market just lost confidence in everything, and you went whoosh. Right. So is it my base case? No, but it's something that you need to think about and your listeners need to think about, so that if it starts to manifest, that they at least have something in their minds that they want to do something about. Right. They might want to take some cash. They might want to buy more gold. They might want to buy some protection. But it's never straight up and it's never straight down.
Yeah, it's always better to come up with these plans when you're sober of thought, as opposed to when you're in the moment of panic and you're just making decisions off of raw emotion.
Yeah, and some dude goes on CNBC and is crying and he, all along he's short the market and wants to stoke fear. That's where I go back to, guys, this is a game of poker. If you don't figure this out and you don't start thinking through the strategies now, and you start responding to what's going real time on traditional media, you're the dumb money, right? And it's a zero-sum game, and that's okay, right?
You've got to look beyond things at face value. Well, hey, Jim, before we wrap up, drop us your socials. Where can people find you?
So I'm on my Twitter feed is, I think, Dr. J Strategy, right? Just follow me there, and that's you'll get all the stuff that I send out. And I'm also on LinkedIn, but and also Wellington Altus. We have a website, and I usually drop my stuff there. You got I usually drop monthly. I'll drop a market insight. So the next one's going to be about AI not being over yes, AI is underhyped. And now you got me writing my August one, right? So I'm talking about, we just talked about it, right? Liz
Nice.
Strauss and the risk, right? You got my August piece. Well, you've got me, in the middle of writing it, right? So it's going to be about, if they don't do something, we're going to have a 1987 crisis.
Okay. Well, if you guys want to see more of Jim, go ahead and check the links down below. They'll be in the description box down below. Also, I'll also have the books that Jim recommended in the description box down below. So highly recommend you check those out too. Jim, it has been a pleasure. Guys, if you enjoyed this content, be sure to give us a like, comment down below. Go, Jim, go. If you enjoyed this content, subscribe to the channel. 87% of you guys who watch this channel are not subscribed. Let's flip that ratio around, and I will see you in the next episode. Bye, y'all.